Kenya is on course, apparently, to reverse an interest rate capping law introduced in 2016. Now, that development is expected sometime in September. It's seen as a result of recommendations, in part, from the International Monetary Fund. Now, the rate capping law was introduced in the wake of public outcry over high interest charges by banks that apparently burden borrowers. According to the IMF staff team that visited the country a little earlier in the month, the move would allow the country to access the near $1.5 billion standby credit facility. Now, commercial banks have repeatedly criticized this rate cap law. They say it has strained credit, in fact, limited it a great deal to the general economy. Kenya has also requested a 6-month extension of that credit facility, which expires sometime next week. Quite a lot to get into as far as this particular topic is concerned, so let's dig into it. Jared Osoro is head of the research unit at the Kenya Bankers Association. He's live in studio with me right now. Thank you for your time.
Thank you, Ramah.
We've discussed this several times in the past, but let's start with the wording that was used in the IMF statement. A commitment to, quote, substantially modifying interest controls. What does that really mean in practice?
It simply means that the relook into the law will essentially entail a substantial repeal of the law to allow banks price credit according to the risk profile of the borrower.
But is that palatable to politicians? Because MPs have sat down and said, yeah, we're going to bash banks. And this was essentially their argument when they passed the law in 2016. Banks have misbehaved, have given you enough time to reform your practices and lower lending rates, and nothing happened. It's a bit difficult for them to walk back now and say, okay, we were wrong, let's repeal the law.
I think it's a case of making a choice between pleasing the politicians and making what a decision that they think is right for the economy. Because the politicians imagine that introducing this law essentially entails bashing the banks. But what has come out is that the interest rate capping has diverse effects and basically restricted to the banks themselves. You could appreciate the fact that the central bank is not able to move insofar as monetary policy is concerned. Therefore, that is one of the effects that politicians didn't envisage. The capital market, for instance, we've not seen any corporate issues since then because of the dynamics around the interest rate capping. And I think that therefore demonstrates the fact that whereas the focus was on banks, the ramifications have been much wider. So I think the choice between pleasing the politicians and doing what is right is easy to make.
Now that you raised it, there's an interesting corollary to that question, because one of the main beneficiaries of the rate capping law has been the government, because they've been able to borrow at, let's be honest, relatively low rates for a very long period of time. And we've seen their borrowing also spike quite a bit. So to some extent, the government also has an incentive here, perhaps, to try and keep the rate cap in place for a bit longer, doesn't it?
I think if you look at it as incentive, you probably will be ignoring the fact that, that has come at a huge cost to the economy, because there's clear evidence of crowding out. So if you look at it as a good thing that the government is borrowing cheaply, then the downside is that it's actually affecting the real economy in a manner that is self-defeating. So I think it's not it may not be accurate to argue that it's an incentive for the government to have the capping there, so that they can borrow cheaply. The other way of looking at it is the fact that because the government may be having a perspective that they are able to get cheap money from the market, it has seen the public debt spiral within a very short time to where it is right now. So it's a double-edged sword.
But if Rotich, for argument's sake, just to take that argument a little further, if Rotich comes back to the market and says, look, I need to refinance a lot of the local debt that I do have, because a big chunk of it has now become relatively short-term, 5-year maturities and so on and so forth, he eventually has to come back and tell the market, look, this is too expensive for me, I need longer-term debt, 10 years plus. Isn't that, again, doesn't that play to his argument of saying, okay, let's keep it in place for a bit of time until the restructuring is over, then we can essentially change back the law? Well,
restructuring the debt that is already existing simply means that it has to come out at a higher cost. That's what it simply means by restructuring. But then at the end of the day, if you continue kicking the ball down the road, while at the same time hurting the economy, you'll essentially be negating the essence of the government picking money from the market with a view to making its operations continue. So I think it will not be really the right thing to argue that we keep it where it is so that we can be able to refinance and draw down the debt that we have over time.
I'm being told to stop playing the devil's advocate here, but one last question for you. Even if the rate caps are repealed, for the sake of argument, there's still the other 800-pound gorilla to deal with in the room, IFRS 9. Those rules are coming into place in the course of the year, and based on what banks said to the central bank in last year's credit survey, They said, look, this is going to hurt lending. It's going to depress it. Unsecured lending, which is the second largest category for households, that's going to virtually disappear. So what happens to private sector credit growth this year?
I think we are not likely to see the private sector credit growth rebound in the course of this year, given the circumstances. But I think we are not going to see the downward spiral insofar as the rate of growth of the private sector in terms of credit taking the trend that it has taken over the last 2 years. Essentially what we are seeing is a situation where we're likely to see a bottoming up of credit to the private sector given all the dynamics.
So we're going to stabilize at what, 5%?
It's going to be stabilized and at around, right now it's about close to 3%, slightly below 3%. So if we start seeing that stabilizing and moving up to about 5%, that will be a drastic turn of the corner and probably a move towards improvement. You can imagine if we have the rate capping and the IFRS 9 coming through, the credit market, especially the segment that you mentioned, will be stifled. But if we have the capping repealed, as all signals indicate it's likely to happen, then I think banks will have to adjust, and I think they have no choice other than to start classifying the assets accordingly in line with the new standard. So that will mean that now they'll have to recalculate their systems with a view to seeing how they can accommodate credit to the skewed segment of the market, with a view to seeing that it doesn't constrain the ability of them to continue lending with the private sector.
All right, and just to give our viewers a bit of context on that, there's about $23 billion or so of outstanding private sector debt. Roughly 16% of that is in that one household segment we were talking about a little earlier. Osoro, thank you very much, as always.
Thank you.